Good morning, everyone. Welcome to this update for global stocks and commodities for the 15th of September. How things have changed in September. Only 2 weeks ago, the market was languishing, and the question was how much further might the S&P fall before it found some stability. And here we are 2 weeks later. We're basically back at a double top, and the market, you'd have to say, is looking more positive than negative. But look, at the end of the day, this is very much a news-driven market, and it's gone back up again because China and America are trying to kiss and make up. And as we know, with Trump, that could change in a heartbeat. So pretty interesting times. Let's have a look at the action for last week, and I'll try and shed a bit of perspective on what might unfold in the next few weeks and few months. The important point that needs to be remembered is that success in the stock market is so much about realistic expectations and a realistic perspective. And, many people don't take the time to get that. And as a result, they make all sorts of overreactions to what the media is saying and to what the market is doing. And it really does pay to underreact in the short term to these gyrations in the market, because a lot of them are just driven by computer algorithms. They're not coming from traders and large institutions making a premeditated decision to sell out of the market or to change tack. It's just computer algorithms just responding to the way they've been programmed. Anyway, more on that. There'll be the normal stock and commodity trend update, and I'm just going to take a quick peek at nickel this week as well, which has had a big move just recently. Portfolio Analyst last week, we did many things, but we did focus on how to trade fast-moving stocks that come out of a consolidation, go into a real acceleration to the upside, and might go up 50 or 100% in a short period of time. And it's certainly not easy necessarily to trade those sort of stocks. Now, the US market, the S&P was up 1% across the week, but there was a fair amount of ups and downs. But you'd have to say, when you look at the chart, that new highs now look more likely than the reverse. But as I said, this is very much a news-driven market. It's one that's constantly on edge. And, anything can happen. What I did note last week, and we saw it here in Australia, is that there was a big swing from the growth momentum stocks, particularly the large technology stocks, back to more value stocks, and also to small caps, particularly in America. The differential was quite massive. In fact, I've never seen such a massive differential where small caps outperformed the big end of the market. So that was quite notable, and that resulted in the Russell 2000, which is the index that reflects the small and mid cap section of the US market. It was very much the outperformer by a factor of about 5 to 1. It was quite extraordinary. And as a consequence of that, the advanced decline line, which is the number of stocks setting new 52-week highs, compared to those setting 52-week lows, basically is now at a new high. So this is a really good sign for the market, because it means that the breadth of the market is continuing to expand. This is not a market, or the S&P index is not holding up purely because people are punting on Apple and Amazon and Google and Facebook. This is a very, very broad-based supported market, and that's a very positive thing. We also saw the US consumer still in pretty good shape. There's been all sorts of dire predictions of doom and gloom because of the trade war and what that would do to import prices of goods from China. But retail sales actually hit a new all-time high in July. So the US consumer doesn't seem to be feeling it at this stage. The US dollar rose very slightly, not a lot of change. But what was notable was the big jump in the 10-year yield. So let's just recap. A year ago, the 10-year broke above 3%. got to about 3.25%, and everybody was convinced that it was heading to 4%, and some even said 5%. So that was only 12 months ago. The US dollar then completely fell apart, got down to 1.49%. The bond yield fell apart, got down to 1.49, and now we've bounced back to 1.9. Now, what that means is that people are selling out of bonds, which was always going to happen because this was probably the most crowded trade on the planet. People buying bonds, it was the greater fool theory. They weren't buying it for the yield, they were merely buying it because the bond prices were going up. Bond prices up, yields down. And so people were buying bonds like they buy stocks, like they buy speculative stocks. And we'll take a look at just how dramatically that transaction played out. All right, so let's take a look at some charts. So we'll start with the S&P, and you can see we had this consolidation that started right at the start of August and finished right at the start of September. So this consolidation lasted for 1 month, and it really wasn't clear whether we would get another leg to the downside, and that certainly wouldn't have violated the overall uptrend at all. But it resolved itself to the upside, mainly because of some better signs from America and China actually trying to reach some sort of agreement. Certainly not resolution, but certainly some sort of agreement. And we're now back within basically 1% of the all-time highs. Now, I don't know where the market's going to go from here in the short term, but if you just look at what is, you have to conclude that the market is more likely to break out than it is to break down. So we're more likely to go up from here than we are to break this level here. However, we are at a double top, we are overbought, and so a move back into this trading range is equally quite possible. But look, it doesn't really matter, because at the end of the day, most people are wanting to trade individual stocks, and really that's what you should be trading. So what the S&P does in the short term is really a bit problematic. But if we look at the Russell 2000, which went up very substantially, so the S&P up 1%, the Russell up 5%. So it was quite a big move, and that's an extremely promising sign for the overall market. Let's just look at the US dollar. So not a lot of change, just really some quite wild swings up and down, but not a lot of net change. But this is where a lot of the action was. So this is the bond, this is the TLT, the 20-year Treasury bonds, and when bond yields go down, that's because prices are going up. And people were buying bonds because they felt it was a no-risk ticket to the moon, because central banks would always come in and always be a buyer in the market. So if you paid 130 or you paid 138, it didn't really matter because the central banks had your back. And so this had become an incredibly overcrowded trade and had to revert to the mean. It was inevitable that this trade would happen. And so eventually it reached a tipping point, I guess, when the market perceived that inflation might turn up, or that the Fed may not reduce interest rates or stimulate as much as previously thought. And so there was a tipping point reached, and people started selling out of this incredibly overbought trade. And so you can see TLT came down from 148 and finished at 136. And in the bond market, that's a big move. That's a huge move. And so as a result, the 10-year Treasury yield went up. So all those things are relevant for the equities market because everything is priced in relationship to other assets. So these moves in the bond market are incredibly important. I'll come back to that shortly. Turning to the Aussie market now, our dollar rose to 68.8, and that's mostly about the removal of some fear that the trade war would really impact China hard and therefore impact Australia hard. And so our dollar, which had got down to about 66.8, has actually risen 2 cents in the last week or two. Our index was up 22 points on the week, so about 1/3%. And we also did see this rotation from the high momentum stocks, stocks like WasTec Global, Appen, Pro Medicus, and a lot of other big technology names came off last week. So we saw this rotation back into some value stocks. Now, at this stage, there's no reason to suspect that this is anything other than mean reversion. A lot of these stocks have just got way ahead of themselves, both fundamentally and technically. So mean reversion back to the trend that you were on is normal, it's healthy, and what it does do is create opportunity for those who are ready and organised. And that is something I'm going to be addressing in Portfolio Analyst this week. So let's just take a quick look at the Australian market. Okay, so there's our market. We had a dip, and then we've basically risen over the last couple of weeks from around 64.50, and we closed the week at 66.70. But there's still plenty of challenge ahead for the Australian market, that's for sure. It's very, very much a stock picker's market, and I believe far more so than the American market is the importance of growth stocks, because I think a lot of the value type stocks in Australia have not only been underperformers for many years, but also if you look at the results from reporting season, and I talked about this last week, it was pretty somber. Not only the results, but the outlook. So I think value stocks in Australia are going to have a difficult time. So I think the place to be in the Australian market is still the growth stocks. Okay, so just while I'm here, I'll look at the gold market. So this was gold on a daily basis. So you can see we had a sharpish move on Thursday, the 5th of September, and that has continued to follow through. If we look at this on a weekly chart, then I think what's unfolding here is we're just getting a consolidation. This was a big move, and I'm not an Elliott Wave devotee by any stretch of the imagination, but Elliott Wave does have some validity. Not so much in price projections, in my view, but certainly in terms of the basic wave pattern format. So this was wave 1, wave 2, wave 3 here is typically the longest wave in the sequence, and then that follows that. You tend to get a more complex phase 4 consolidation where it's a bit more of a washing machine. Wave 2 tends to be a fairly simple decline, generally a 3-wave decline, and then we take off on the longest leg of the sequence. Wave 4 tends to be more complex because it's more of a tussle between the buyers and the sellers, the argument about who's right. So this may play out now for a few more months. So expect some ups and downs in gold. But when that is complete, be it a few weeks or a few months, then we're in for another leg to the upside, or highly likely that we'll get another leg to the upside, and perhaps to something in excess of $1,600 an ounce would be consistent with the pattern. Now that's not a prediction by any stretch of the imagination, but it's just what is normal and what is consistent with human behaviour and how things play out. So that's a bit of a roadmap on gold that might assist. Okay, so let's move to precious metals. So gold fell by $17 down to $14.89, and I think it fell $15 the week before. So gold was down 1.13% for the week. And what I wrote last week was it's likely that there'll be more selling next week, and that's in fact what we got. This is it's just normal. So don't think that the rally in the gold market is over, although there's been some more amplified corrections in the actual gold stock area. GDX, which is the ETF, the global ETF that reflects what's happening with the 15 or 20 biggest gold stocks in the world. That was down 6.5%. Now, the normal relationship between GDX and gold is normally about 3 or 4 to 1. So this was more than 6 times. So, and again, that's not unusual because gold stocks do tend to lead in both directions. So the fact that GDX is down by more than would be normal is indicating that gold is probably going a bit lower yet. So GDX down 6.5, but if you look at the most local stocks, most local producers, so you look at Northern Star, Saracen, Evolution Mining, Regis, etc., most of those local producers were down between 8 and 10%. And that sort of makes sense because the Australian dollar also went up during that period, and so that has created an even larger decline for the Australian gold stocks. Let's just take a look at GDX. So you can see quite a sharpish move. We only had one up day since the 5th of September. So 7 trading days, only one of them was up and fairly weakly. So I think we've probably still got a bit more downside in GDX yet. But don't throw it in the waste bin. At this stage, the uptrend in gold and gold stocks is still very, very much intact. Okay, so from my perspective, we're probably not there yet. In fact, it's unlikely we're there yet. But there is a buying opportunity brewing in the sector, that's for sure. Turning to other commodities, copper jumped quite sharply to 2.69. Inventories actually fell a bit. So the demand side response was, it's a little surprising. So perhaps a bit of fun and games in the futures market being played here. Crude oil also eased down to 54.9. There was a rise in inventories, and so that put a bit of pressure on crude oil. There's the 1-year spot copper chart, so you can see right over on the far right-hand side, quite a sharpish move last week up in copper, and of course the inventories came down, and that sort of fed into that rise in copper. Now, I mentioned that I would also just touch on nickel. So nickel has had a big move in the last couple of months, and this is stemming from rumours, probably with a fair basis. They're as yet not confirmed, but the indications are that Indonesia has put another ban on the export of low-grade nickel ore. They did it several years ago, and they said they were going to do it from 2022. It looks like they've moved that time frame forward, and Indonesia is, I think, is the largest, if not one of the largest, nickel ore exporters in the world, and so that obviously reduces the amount of nickel in supply, and so the nickel price has moved up quite strongly in response. Now, the reason I raise this is it's the nickel stocks in Australia have done really well, and I dealt with this in Portfolio Analyst 2 weeks ago. And just as one example, and this is not a stock recommendation by any stretch because it's already moved a fair bit, but Western Areas is one of our more prominent nickel stocks, and it's up 33% basically just in the last month or two. So there's been some big moves in nickel stocks in Australia. All right, wrapping it up, it's incredibly unlikely that we're at a top in the market. It'll be the first time in history that we've had a top in the market without an exuberant blow-off, and where sentiment is so poor, and where the positioning of a lot of people is as it is. Money has been flooding out of US stocks this year, despite the fact that new all-time highs have been set. Now, I find that statement conflicting and confusing, and I must admit that I don't understand if money has been flooding out of US stocks, and I'll show you the facts in a minute. then why is the S&P at all-time highs? And I just don't have an explanation for that. But the facts are, and I understand that this is factual, that $200 billion have flowed out of US stocks, out of mutual funds this year, and $700 billion has gone into the bond market and money markets. Now, if you think back to the chart of TLT that I showed you, that's gone up. So that's consistent with $700 billion going into the bond market. But certainly the $200 billion coming out, if you looked at the S&P, you'd be forgiven for thinking that's not the case. But I understand that that is a factual piece of data, and if that's the case, then that is not the behaviour that you see around market tops. Mean reversions are always going to occur. We're seeing that in growth stocks. We certainly saw it in America last week. We saw it in Australia last week, and I think it'll be fairly short-lived. Portfolio Analyst, this week I'm just going to, amongst many other things, I'm going to be just presenting a realistic perspective on the project that I started a few months ago, which is the building and monitoring of a portfolio of stocks that have the potential to go up tenfold or more over time. Now, this is a project that will unfold over perhaps 3 to 5 years, but I want to present a point of realism around that particular project. So that's it for this week. There's my contact details for any non-members, and I'll be back with you next week. Cheers.